All right, good stuff. So, welcome everybody, and thank you for being here. This is another webinar, web class. I held a couple in the last sort of month or so relating to the footprints of the large liquidity providers, and hopefully some of you guys, I know some of you are on those calls, so I hope you've found that information helpful and practically useful. That's what these sessions are really about, little tips and tricks that I can help you in generic terms to make better decisions, take better trades. Because obviously, if I don't know you personally, if you don't trade with me, etc., I have to deliver obviously more generic information that'll just be broadly helpful to the group as a whole. So, did anyone come on the anyone who came on the footprint call? Has anyone had any useful aha moments since you learned that information in terms of how you can use that information in the markets? Have you had any success with reading any of the positioning? So if you want to stick it in the chat, if you have, cool to find out. All right, so these, as I say, there's just some web classes relating to some general topics, and this one we're going to be talking about a couple of important topics relating to how you go about actually learning to trade and interact with the market, and also I'm going to cover a way for you to think about your exits a little bit more professionally, because as we all know, entering the market is one thing, but exiting is quite another, and it's one of the biggest challenges that traders face. Yeah, so I'm going to cover these topics that I think you will find helpful. So without any further ado, let's get cracking. If you don't know anything about me, 20 years Forex experience. I've been a contributing analyst at the brokerage firm markets.com, authority, allegedly, on all things market maker, trap trading. I own the trademark to that phrase, stop hunts and market manipulations, head trader and trading coach at the Underground Traders Alliance, former prop trader and former trading coach at the Lex Van Dam Trading Academy. Lex was head of FX at Goldman Sachs in New York, and was the gentleman who did the TV documentary for the BBC, $1 Million Traders, where he put up $1 million of his own money and was trying to prove the point that he could teach novices how to trade. And he actually managed to do that. If you've ever seen that, worth a watch. It's on YouTube. So yeah, feel free to have a look at that. YouTube channel, got a YouTube channel. It's tiny compared to what it used to be. I got hacked. Yeah, and I also created the world's first behavioral management software, and that got stolen. So we've had a right old time the last couple of years. All right, so that's a bit about me. Okay, so today, what I want to talk to you about today is, I mentioned that I was a contributing analyst to markets.com, and markets.com are a large, heavily regulated broker. Now, when speaking about brokers, I know obviously we all think of them as a bit of the enemy, but as a broker, I'm not here to promote them. But what I'm here to sort of highlight for you is that I got the sort of inside track, if you like, to be able to see the actual workings of what happens to retail traders' trading accounts from that experience. And I can tell you that no matter how well regulated a broker is, no matter how much stuff they put out there, the bottom line is that the issue with trading is that the ability for you to be involved in trading has been democratized. And ultimately, what that means is anybody can open a trading account. Now, while that is wonderful in the fact that someone could do that as a choice, as a decision to look at becoming a trader, the problem is that you're sort of left to do it without your stabilizers on. You know, like you were learning to ride a bike when you were a kid. You had the stabilizers on so you didn't fall off and hurt yourself until you became proficient enough. Unfortunately, that doesn't exist in the trading world. That's what I was actually trying to do with my behavioral software, because I realized that people on their own, left to their own devices, can't generally do it. And that's the problem. So when you look at the statistics of why so many traders fail, it's not because someone bought a trading strategy and it wasn't very good and the trading educator was an arsehole and the information wasn't very good. Those things are possibly true too. But the bottom line is that the individual it has free will. And unfortunately, we as humans, we don't like pain, so we avoid it. And as a consequence of avoiding pain, the net result of that is that we try and avoid it, meaning a stop out, right? And as a consequence of that, all the trading dreads that you can imagine will ensue. So, you know, you cancel your stop, you average into a position, the market just massively goes against you. You get on the wrong end of a fundamental trade, you get on the wrong end of a news event that's a big one, and you're in serious trouble and the account's gone. That's not trading, guys. And although that's a lot of people's experience of trading, it's not trading, right? The other issue as well is that not only do you have the free will, so it's like, look, don't touch, but don't taste, but don't swallow, right? It's like, he's a stop loss, but you can cancel it. He's what we suggest in terms of risk management, position size management, but you can increase it, right? The issue is that it's left to the individual. And when you have money on the line, when you have emotions on the line and pain avoidance, it's not a good recipe. And ultimately what that leads to is disaster. And that's why the statistics are so terrible, so bad. Now, what does this mean? Well, what this ultimately means is there's an awful lot of people losing a shit ton of money for, number one, no reason. And I'm going to explain that in a bit of detail in a moment. But number two, you're not experiencing, there is a huge amount of people not experiencing what trading actually is. Right? There's a complete distortion about it, because if you come in, you blow an account, you're gun shy, you're annoyed, you're angry, you're frustrated, you're vengeful, all of those emotions, you may never come back to trading. You may, do so much money, you're in serious trouble. And I've, trust me, heard some truly horrendous horror stories over the years of people losing millions that had no right in the market to find themselves in that predicament, but they did, because they had a few quid and they didn't know what they were doing. And unfortunately, all those things collide, what I've just been talking about, and it's a recipe for disaster. So what people's experience of trading is massively tainted as a result of that. But also what's problematic is that someone never gets to actually interact with the markets and understand that area of trading, which is not talked about. You've got technical analysis, fundamental analysis, sentiment analysis, intermarket analysis, you name it, analysis. But what you don't have is how a trader actually interacts with the market in terms of the mixture of the psychology of that and also the trade management side of that, and those things coming together. And the fact that those things are also grayscale, right? You get stopped out in numerous different ways, right? If you look at your trading ledger at the end of a week or end of a month, and you've got a number of losses on your account, there's a story behind that loss. On the ledger, it just says minus XYZ, right? But there's a story behind that loss, and each one of those stories are different. Meaning, if you take a trade and you get stopped out and it was a slow grind, it never really got going, you've been sort of in the trade overnight, and you've maybe been in it a day or two, and it's kind of bouncing around break even, but never really did what you thought it was going to do, and then kind of a bit of a slow grind towards your stop and ultimately pop, you get nailed. That's very different to taking a trade the instant you take the trade, in a blink of an eye, you're stopped out. Now, on the ledger, the two things are the same, right? Or hopefully they are. Usually they won't be, because people will leverage randomly, and the position size will be random, and all of those things that are left to your devices and the next person's devices, and again, free will causing the problem. But let's assume that you did take the right position size and the correct position size, and you took those trades. The ledger will say minus XYZ in 2 occasions, but it doesn't tell the story, right? The way that you got stopped out with the blink of an eye scenario versus the slow grind is vastly different, and no one gets to experience the grayscale that exists between those things, like how you make money. There's loads of grayscale. How a trade retraces against you is grayscale. How you get stopped out is grayscale. How you manage the trade is grayscale. How you navigate through news events is, there's a million different scenarios which all have their own different variants, and you have to be able to learn to experience them and learn how to circumnavigate them. But most people can't, because they're not doing that, because they're too busy having a problem at the front end in terms of too much risk, getting into trouble, risking too much money, losing too much money, blowing trading accounts, etc. So here's my number one top tip, and it's not sexy, but it is if you want to become a trader ultimately, and that is reduce your risk to near zero. Now, that doesn't say 1%, that says 0.1%. or 0.2%, or the absolute minimum amount you can trade with relative to what you've got in your trading account. Because I realize some people's accounts are small, and you can't get to those lower numbers as easily. But whatever you can do, go there. Just go at the minimum amount possible. Not 1%, not the widely touted 2%. That's absolute bullshit. Because 2%, if you risk 2% and you do what most people do, which is try and take 10 trades in a day, right? You can put an enormous dent in your trading account. You'll come again the following day. You'll try and take another 10 trades, and you're in serious trouble, right? There's not many people coming back from a scenario like that. And of course, when your trading goes down the pipe like that, the other reality of that scenario is that there's degradation in your ability to trade your ideas, because as the drawdown gets worse and worse and worse, your mentality deteriorates. So you're much more predisposed to taking more risk, to try and get the losses back, and taking trades that are not really trades. The market's all of a sudden going higher, and you just jump on because you were short a minute ago, but it's going up. So you think, oh, screw it, I'll jump on the trade because I want that loss back. It resembles nothing relative to your trading strategy. You're just gambling. You're just reactive. You're just emotional. You're just jumping in. So that's not even considering that, which is obviously extraordinarily prevalent. So what you need to do is you need to reduce the risk to the lowest amount possible, which is going to allow you to focus on what you're supposed to focus on, which is execution on the idea, the strategy that you're trying to use. That's the day job. That's what you're supposed to do as a trader. But as I say, hardly anyone gets to interact with that area of trading because they're too busy screwing it up on the front end. So reduce it down to the lowest possible figure. Just because you do that, don't think that, I should mention, don't think that like, well, how am I going to make any money, Mark? It's not about that at this point. What you've got to get into your head early on, or at any stage really, is that you need to really forget about the money and focus on what's important, and that is being able to actually trade. And that this is what this allows you to do. I'm not saying that you'll stay at 0.1 forever. I'm not saying that that's not potentially a very small sum of money in terms of, why bother if I'm only going to make so little amount and stuff like that. But don't worry about that. It's not what it's about. It's about de-risking and then being able to actually participate proper. Also, I should mention is you don't want to be taking loads of trades either. You don't want to be that guy. You want to be taking trades that make the most amount of sense. And when you actually take the trade, you're doing your utmost to actually attempt to put your best efforts forward. And trust me, you can't do that from the standpoint of taking 10, 20 trades in a day. You'll lose focus. Not every trading pattern is created equally, et cetera, et cetera. There just really isn't a realistic 20 trades that you can take in a day that are actually meaningful. There might be one, but certainly not 10 or 20. So if you de-risk and you come at it from a perspective of not over leveraging and over trading, sorry, what I want you to think about is this scenario, and just, you know, you don't have to answer it in the chat or anything, but just sort of consider how this has been for you previously or currently, etc. What's the story of how people trade when the trading starts to go into a drawdown? You know, and whatever your strategy might be, you know, you'll attempt to follow it that first time for sure. You know, you've got bags of energy, you've got bags of enthusiasm. Maybe you just bought a trading course off someone, or you've been mentored off someone or something, read a book, etc. And you take the trade and it doesn't make money. And unfortunately, because of the way that the industry is framed, you think of that as negative. And the problem with trading is there's loads of different words and ways of describing things that are terrible and not true and are totally unhelpful. And one of them is loss, as is win, by the way. Thinking of a trade as from a loss, calling it a loss, is a very, very negative thing. Now, it's not that you can't take a trade and not make money and that be a negative thing, because it can be, and generally speaking, a loss is a negative thing for the vast majority, because not because of the loss itself, but because of the way that you lost. You didn't stick to your rules, right? You took a random trade, or you took a trade, you took a loss, then you just hemorrhaged outside of your strategy, and you're doing all kinds of things that is not relevant to what you were supposed to be doing. So someone takes a trade, it doesn't make the money. They take a second trade, it doesn't make the money. They take a third trade, doesn't make the money. Fourth trade, doesn't make the money. Fifth trade, doesn't make the money. Sixth trade, doesn't make the money. Seventh trade, doesn't make the money. How many people have kept going from 7 trades that didn't make money in a row? I'll get you to answer that one. So in the chat, how many of you have taken 5, 6, 7 losing trades in a row and kept trading? I'd have stopped around 7. That's quite a high number, I would suggest, Howard, actually. Ken, me, right? I would suggest it's less, right? Most people don't even get that far. Most people are starting to have a real problem with the idea 3, 4 trades in. And by the way, this is presupposing you're actually moving forward, because of course, there's an awful lot of people don't even do that, right? They take the first trade and they don't make money. And as that trade's going against them, this is where they hemorrhage. So they average in and they do all the trading dreads from there. So, you know, a lot of people don't even get past that first initial trade to experience going forward. But let's assume you have gone forward. How many trades have you genuinely gone forward to prior to actually saying, you know what, this isn't working. I'm going to go and do something else. I'm going to buy another trading course, buy another book, take another strategy, use another strategy, read another strategy, chat on a forum about another strategy, right? Blah, blah, blah. 10 years of failure got me to number 7. I like that. Ken, yeah, I found out when I first started that emotion can lead to using bigger risk after the draw. Yeah, absolutely, Ken. When I realized the risk is, number one, my outcome changed drastically for the good, and the emotion aspect of it got a lot better. Yeah, good man. And that's the point, right, Ken? Like, loads of people unfortunately don't get past that point because the unfortunate nature of how these things sort of interact with each other is that you blow your account, right? Or you blow several accounts in one fell swoop. And you're out the game with a dreadful experience, and as a consequence of that, you'll never ever get to where you got there, Ken, which is beyond that. And now you're experiencing what it's like to actually learn to trade, and it reduces the emotional impact on you as a result of that. So that's tremendous if you're in that position. Well done. Yeah, a lot of people don't get to that point. Yeah, loads of people quit at that point, and the problem with that as well is that they quit and they'll go and, I understand it, but they'll go and slag the industry off, right? Is it the industry's fault? Yeah, the industry's to blame, but so's the individual. Do you know what I mean? So, but unfortunately, they don't see it that way. They, you take the loss and you're pissed off about it. Or worse, it can be dreadful, like truly dreadful. Some of the horror stories. I had a friend who had made a lot of money in his life. He had a main dealer, motorbike dealership in a lovely part of London, in Putney, and retires to the south of France, made his money, decides to renovate a villa. That took longer than expected, but when that was done, he had visions of trading, buys the poolside with his laptop. And he the first week of attempting to do that, he lost £250,000. Now, he'd made money, but it doesn't matter, right? £250,000 hurts anyone, and he never came back from that. He lost £250,000. There was another guy in America, had made $3 million in his life, had his own business, had done well for himself. His wife divorced him. He lost the other $1.5 million trading currencies. And he was at an age where he's never, ever going to come back from that. The money he made was like one of those first mover advantage type scenarios. He was never going to make that money again. And he's, the guy, it's like jumping out of a window type stuff. I hope he never did, but it's that type of thing, right? It's that bad. It can be that bad. Yeah, it does give the industry a bad name. The industry deserves a bad name in many ways. So let me tell you a true story, and it's quite a comical story. So as I mentioned at the beginning about me working with that particular broker, I actually, the people who were training with me, they reduced payments to me because none of my traders were losing money. I was making money from the broker. And the broker was making no money because the people who trained with me didn't lose their accounts, were trading properly. But that's not normally the case, right? Most people, that equation's the other way around. The traders are meant to come in, lose their accounts, the broker makes a ton of money, and that wasn't the case with me. And it's because of these things. It's these ideas, these concepts, which I was actually trying to put into some software. It's these manual ideas, though, that if you take them on board, will stop you from doing that and get you to a point, like you mentioned, Ken, that you ultimately actually at least moving forward and learning to feel what it's like to interact with the markets. And, it's a hugely important area of trading. But again, no one interacts with it, because if you get bitten, how are you going to interact with it? You're never going to interact with it. You're never going to experience it. You're never going to learn how to cope with it. Nothing. So you never traded, really. Well, not really. You never traded. But try telling that to the person, of course. So my experience is that most people don't go beyond, 4, 5, 6 trades max. But the reality is, what you've got to do is you've got to plan for a whole load more trades than that. And you've got to, it says 26 trades here would be so far out there on the bell curve, right? Imagine if you had 26 trades in a row, all didn't make money, double it for me, 52 trades. Think like that. Think worst case scenario and think, I'm going to trade as if I can cope with 52 losing trades in a row. And by the way, anyone who's ever worked with me, the people who stay with me get to that point, and they're never going to experience that as a consequence of actually thinking in these terms, because what my guys do is when you're going through a drawdown, which is a natural, normal, necessary part of trading, it's just normal. It's if you take a great trade and it doesn't make money, it was a great trade. It's just a trade. It was a great one, or it was a good one that can be improved upon, but it's not a loss. But rather than falling victim to the loss mentality and the negative connotations that surround that, and how that impacts you emotionally, my guys double down on process, double down on making sure the next trade they take is one that is of a higher standard that they're capable of, or they're at least attempting to hit that highest standard. Of course, we're human, we all make mistakes, but our mistakes as you go forward become so small versus, you know, what's an inexperienced traders would go through. It's not a big deal. It's just, you know, must try harder, must fix that next time I take a trade kind of thing. And it might equate to taking one trade that ended up in a loss that maybe you didn't have to take, but that, you know, it's not the end of the world. You know, set your stall out to have 52 losses in a row. Think about setting your stall out in that way. Forget the upside. Could you swallow 52 losses in a row? And every time you take that loss, can you maintain your discipline relative to the idea that you're trying to deploy? Because this is the other thing about this process. The quality of your trading decreases. There's degradation, sorry, easy for me to say. As these trades continue to lose for you, in your mind, you're just freaking out. So you're trading, you know, that last loss, let's just say you did quit at 7, as I said, probably less than that, but let's just say it's 7, right? Whatever trade you took in that first trade doesn't look anything, that last one doesn't look anything like that first one. Whether that be from a risk management perspective, whether that be from a strategy perspective, like you're looking at what you've done, you're like, what the hell, you know, what is that? That's not even what I'm trying to do. You know, and that just doesn't, it's not binary. It doesn't just start from the first one and end up at the second, the last one. It happens as a progression. The speed of the progression is such usually that this is why you probably don't get to 7 trades, normally speaking, because it accelerates and, you know, your emotion accelerates, so does the degradation. But when you set your stall out to think in terms of, I could take 52 trades in a row. By the way, get your trading account, get your calculator out, and let's just say, I don't know, let's just say you got £2,000 available for your trading account. It's kind of the average in the retail world. You got 2,000 quid. You're going to try, you know, to trade with the 2,000 quid. Get a calculator out, take your 0.1%, right, and just keep losing and see how many trades you can take before that goes to 0. Trust me, you'll get bored after about 100 trades. And you might be very surprised at the extent of which you've not put a huge hole in that account. Yeah, it would take a bit, it'd take a hell of a bit, right? That's the point. It's the whole point. It's unlikely. It's never going to happen. It's probably something like 700, 800 trades. It's never, ever going to happen. And that's the point. So what that does is that allows you then to go through this type of thing mentally before you ever start out, or if you're in that process now, start afresh and think of it in these terms. And what this ultimately allows you to do is interact with the markets proper. Now, one of the ways that the tendency for you to experience a drawdown, what happens, usually speaking, is that happens early doors in the scenario. So the law of large numbers is actively working against you in this context, because what's the law of large numbers? It's basically it's a theory and probability that explains how numbers distribute over larger sample sizes and indeed shorter sample sizes over time. So think of this early scenario as like 0 to say 20 trades. And what you're getting in here is really lumpy and quite unpalatable performance, right? So let's just think of it from this perspective. Imagine you've got a coin in your pocket, right? 50p in England. You've got a coin in your pocket and you flip it. It's supposed to be 50-50, right? You flip it 10 times and you don't get 50-50, right? It's absolutely reasonable that you could get 2 tails and 8 heads, right? Well, how so? Like, I know it's not very technical and it's not very scientific, but imagine it was. Imagine the forces were all the same, the temperature was all the same. It was all very scientific. They flip the coin, the fair coin 10 times, you get 8 tails, 8 heads, 2 tails. What's wrong with it? It's supposed to be 50-50 distribution. Of course, it's not, because the sample size is too small. So, but you carry on doing that into the future, into, let's say, 200 coin flips, 200 fair coin flips, you'll get somewhere near your expected value, right? Your expected value of 50-50, but only if that thing moves forward into the future long enough. And by the way, it doesn't just get to 50-50 and remain there. It deviates from it again and goes back to it. And this is drawdown, right? You don't just take 200 trades, hit 50-50 and stay there. It's not how it works. So going back to the scenario that we've just been talking about, what's the worst can happen? Most people do, 1, 2, 3, 4, oh, you know what, screw it, it ain't working. They go buy another trading course and guess where they find themselves? Unknowingly, the wrong end of a very small set of sample, very small set sample size, where they will experience the same thing, most probably straight away. Lo and behold, what will tend to happen? They'll take those 1, 2, 3, 4 losers, whatever the number, they'll go, you know what, screw this, it ain't working. I'm off to have another trading conversation on a forum somewhere, buy a book, buy a course, buy a mentor, mentoring thing, whatever. And it just goes round and round and round and round and round. And this is why you get people who have been around for donkey's years who've never strung anything together, because they've never actually taken, just answer yourself this. Have you ever took 100 trades, broadly speaking, remaining inside your process? Seriously, like, forget 100. Have you done it 10 times? Have you done it 10? Now, it's never going to be perfect 10 times. I'm not saying cookie cutter 10 trades all the same. It's impossible. But can you deploy a trading strategy that you can faithfully attempt to trade that said strategy 10 times in a row with the adjustments for things like, maybe not quite hitting your entry perfectly, because entries are always a bit of a moving target. Some days you might nail them, some days you won't. That doesn't mean the strategy's in the bin because your entry is somewhat mistimed. That's not what I mean. So broadly speaking, though, you stick to the general overall strategy 10 times. Have you done it? Have you done it 20 times? Most people haven't. Most people haven't, because we're avoiding the pain, right? We're avoiding the pain, and we're wrongly associating a losing trade with something that's negative. It's not. It can be if you come off your process and take some random, stupid, emotional trade, which, by the way, we've all done a million times over. I'm not talking here from the ivory tower. I've probably blown more accounts in the early days than most people. But, moving forward, like, it's not a negative thing. It's only negative if you hemorrhage outside of your process. But if you take a good trade, the outcome is whatever it is, let's say, and again, loss is not the correct word. I'm at a loss to try and replace that vernacular, but it's not the right word, because if you take a trade, it's really just a good trade or a bad trade. And if it's a good trade, irrespective of the outcome, then ultimately it's brilliant, well done. It doesn't mean that you can't learn from it. It doesn't mean that there wasn't potentially something you could have done better, something you missed. These are all things that professionals go towards. When I finish a trade, when a trade's over for me, I analyze the hell out of it to try and understand, is there something I can do better? Was there anything that I missed? Could I have done this differently? Could I have done that better? And then you take those little adjustments into the next trade and you try and improve upon those little adjustments. And by the way, that never stops. Like, I've been in this game 20 years. It doesn't end. What changes though is that your skill set tips. You're actually trading over a long period of time, and your skill level tips. So you go from that negative position to a break-even trade, and then you tend to break through from there. But it never stops. It's not a destination where you're going to get to this utopian version of you as a trader, Ken, or you as a trader, Hamid. It doesn't exist. I liken it like this to being in a swimming pool. It's probably not a good idea to do this in a swimming pool, but have one hand tied behind your back with a beach ball on the surface of the pool on the water that's way bigger than your hand that's not tied up, and you're trying to grab it with your hand. Right? You're trying to grab it with your hand, but you can't, obviously, you never can. That's trading. You can head towards it, you can swim down the pool towards the ball, you can touch it every now and again, and there'll be flashes of perfection. That's all there'll be, flashes, and then you'll make mistakes again. But the point is, your mistakes are minor. The things that you can focus on and try and not repeat the next time out, and you go again, and it's never ever career ending at that point. Yeah, does that make sense, guys? So you've got to get this stuff going in order to ever have any chance at all of becoming a trader. Like I believe, you know, the information that we use and that I've got relating to trading is the pinnacle of trading knowledge, outside of knowing some insider trading knowledge. That's the level of trading information that I believe I possess. But none of that matters if you can't do this. If you can't do this, it doesn't make an ounce of difference. This is the most difficult thing. Yes, of course, you need a strategy. And yes, of course, you need to be lucky. You need to come across the right people, and all those things are true. And you've got to be willing to put the hard work in. But you can't do this. Forget it. You can't. You're never going to trade. You're never going to make it. So how we've got to set our stall out is to accept the fact there could be loads of losses in the beginning, but it doesn't matter, because we understand that the law of large numbers is actively working against us in the early stages of any trading. And what we need to do is we need to keep going forward and get to those 50, 100 trade, 200 trade sample sizes to actually see if what we're doing is any good. And by the way, even if you got to 200 trades, imagine you did, and you faithfully took trades, broadly sticking with your ideas and your strategy, and it didn't ultimately make money. Do you know how much money you would have lost? I can tell you it wouldn't be very much. But what you have done is you've become a trader. Your problem now is you just haven't got a very good strategy. But you, as an individual, you just need a strategy, because at that point you are an embryonic trader that is perfectly poised to become profitable. It's just the strategy isn't working. So you need to shift that. But that's where you need to get to. That's what is at the other end of what seemingly is this impossible wall of negativity that you can't ever seem to get beyond. But you get beyond that, what happens is you interact with the market, because the market is just hyper predictable. How the market, it's not hyper predictable in terms of like, where's the market going tomorrow, 3:30. What I mean is, there's not that many things it can do, right? If you take a trade down in here, there's expectation, there's a bit of hope that this thing's going to work. It goes your way. These points, this maximum point of equity high that you're in the trade is the most happy moment you are mentally by default. I'm not saying this is how you should be, but by default, that's the pinnacle of that moment, which is a pressure point. It's a feeling one way or another. In this case, positive. That's predictable. It's totally predictable. If that starts, and when that starts to retrace, your mood will shift. You will be happy, but you ain't as happy as you were over there, because you don't have the equity, equity that you had a moment ago, right? And as that continues, those wars continue, and then you start having it gets to the lowest point. This is the worst moment in the trade mentally, right? Sad face emoji. Starts to perk up and starts to pop up a little bit. You'll feel better again. You won't feel like you did there, but you're feeling better again. Oh, hopefully this will break to new highs. And lo and behold, it does. And it goes to new highs again. This is the happiest moment of the trade you've ever experienced, etc., 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 etc. It's all predictable ahead of time. It's just you don't quite know how it's going to look and how it's going to present in terms of the speed in which these things happen, etc. Obviously, there are variations, but there's not many things it can do on the journey to either ultimately you coming out the market after all your take profits are hit, you coming out the market after some of your take profits are hit, you coming out the market at break even, or with the trade that didn't make you money. That's it. That's all it can do, really, unless you go beyond that and you blow your account, right? Which is obviously another option. This is the part of trading that you won't get to interact with and learn how to cope with it if you don't get the other stuff right, because you're never, ever going to experience what it's like to use these experiences to actually improve and know what it's like to trade, feel those experiences, learn from them, build up those mental representations that, oh, I know what this feels like because I've seen this before, and yeah, and you recall those previous experiences so that you become a better trader and you deal with that new circumstance, that circumstance again in a better way than perhaps you had previously, etc., etc., etc. You'll never learn to manage a trade and manage your emotions as well as the mechanical management of a trade unless you get to that point. And no one does, right? The vast majority of people don't get to this point because, as I said, they're gone on the front end. Makes sense? Anyone got any questions? It's just an area of trading no one talks about. The people will say, "Oh, the psychology of trading," but that doesn't explain it. Is your one-on-one coaching for 10 days? It's over 10 sessions, Hamid. So it's, it could take 2.5 weeks. Usually takes about 2.5 weeks. But it's flexible. I work 4 days coaching, so I do Monday through Thursday. But if someone needed to do it over a month, or it makes no difference. If someone wants to ram it in over 2.5 weeks, they can. Is the one-on-one group? No, it's just one-on-one, mate. It's just you and I. Yeah, Eastern Standard Time's great. Yeah, I'm in the UK, so Eastern Standard Time's absolutely fine as a time zone. No problem at all. As I say, just every situation is different. I have guys who Central Time, Pacific Standard Time, and we make it work. I have to confess, Pacific Time is ruthless on me, but it's a 7 o'clock 7 o'clock start in the morning. But we've done it. We do, I do it. This is the thing with mentoring. You do it for as long as you sort of can. There was a long period of time I didn't stop doing it because it is a lot of hard work. So you sort of get mentally drained and you sort of give it up for a period and then come back to it. That tends to be how it goes. Eduardo, hello, my friend. Anyone got any questions? Makes sense? Anyone? Hopefully that's been helpful, guys. So ultimately, what this boils down to is, process. Imagine this as your trading strategy, and that's the box of that incorporates everything: your psychology, money management, position size management, trade management, strategy, everything, psychology, everything's in this box. The problem is when all those other things are not right, what happens is you hemorrhage outside of that box, right? And you just blow up. And as I say, your last trade, whenever you decide to not continue on with that strategy, whatever that last trade is, doesn't never look like the first trade you took or one that you took in the sequence of losses, because you hemorrhage outside of your process. So you look back at a blown account very typically and you go, I don't recognize what I was even doing. How on earth did that happen? Because you're emotionally charged and driven, obviously, and your strategy just goes out the window. You cannot stick to it. And ultimately, that's the job, right? That's the day job. What you're supposed to be doing is you're supposed to be doing your best to stay as faithful as you can to the strategy in question. Yeah, can you talk me through like win rates and stuff like that? So Ahmed, that's a really straightforward question. The win rates, position size, all those things, it's a nonsensical question, and I don't mean to be abrupt to you or anything like that. It's more of a metaphor for anyone, to be honest, because what matters is what it doesn't matter what I would do or the next person would do. You can't contrast that with what you ultimately are going to do, right? Someone might have been around for 6 minutes versus 6 years versus 60 years. You can't. It's a fallacy. The industry is totally set up for people to focus on those things, but ultimately it's irrelevant, because all that matters is how do you perform and can you improve to the point where you can do this yourself. That's the key. That's the key. Hope that makes sense. Anybody got any questions? You good? Everyone good? Cool. Well, I hope that's been helpful. And if you are interested in doing any mentoring with me, here's my email address. Myself or my assistant will get back to you. And yeah, in particular, what we deal with specifically is the actual business model of market makers. So it's not what's online. It's not what people think it is. It's completely different. It's different level stuff. Within the group, we've got school teachers who came to me during COVID and are now full-time traders earning full-time incomes. So this, in terms of, does this stuff work? I've got more people who are trading prop accounts than I imagine pretty much anyone in the world, to be fair. Hi, Ken. No worries, mate. Take care. I'm glad you found the information helpful. Harry, can we talk about how you can scale this? I am in between going all in this and going all in and starting the business. Well, yeah, I mean, the reality of it is how long have you been trading, Ahmed? Too long. 10 years. Yeah, I mean, I had a guy who has I've just done an interview with a guy who was in the exact same boat, 10 years trying. It's on my YouTube channel. Yesterday I published it, and he's about to basically get a 100 grand account, and he did 8% last month, and he's halfway there this month as well. He's already done 4% this month. He'll walk that remaining 4%. The reality is you don't need to go all in. You know, a smart move would be to sort of keep your options open and be able to do both. And if you can scale both, you can scale both. I wouldn't do one and not the other. There's so many variables as to whether or not. See, that's the other thing about win rates and stuff like that. There's so many variables. It's just not even worth talking about. You know, what is someone's psychology? How well developed is it? How many years have they been trading? Those years you've been trading, how disciplined has that trading been? How genuinely how much effort has been put in that period of time? There's so many factors. How much money someone got? How much money doesn't someone have? You know what I mean? There's so many elements to it. Yeah, well, if it's been a shit show for you so far, mate, you know, I understand that. I appreciate that. And you know, I sympathize definitely. But what I can say is part of being able to focus on a strategy is these principles, albeit, you know, we've talked about them rather briefly today. It's these principles being put into play that build a foundation for you to move forward from. You know, I'm not even joking. I must have a tiny group of maybe 30 guys in this group. I must have half of them making money. Like, no jokes. It's maybe higher than half. Because they've got these foundational concepts in the bag, and now they can put the strategy to bear on top of that foundation. It's just, you know, it's a corny analogy, but you build a house on sand, it'll fall down, right? You need the foundation. It's just the same. It's just the same in this regard. So. But I can definitely, you know, 10 years in, that's the type of person I want to help, because, you know, if you've been in 3 years, 5 years, I can't help newbies, unfortunately. I haven't got the capability to help a newbie. You're too far behind. But if someone's been around a long time, it's the perfect fit, because I can take you from where you are currently to where you need to be very quickly. Like I say, I've you know, I had Ian, one of the guys you'd meet in the group. He was a science teacher in the UK. You know, family man. His wife's a school teacher. He's a science teacher in a secondary school, and he packed it in. And he literally, you know, he trades. His win rate, you know, if we want to talk win rates, his win rate's something like 96%, which is insane. And I actually don't even like quoting the number because it's irrelevant. What's relevant is that it's about, can you do it? And the answer is yes, because it's repeatable. It's ultimately the business model of the market makers. I don't know what to tell you. It's how they actually participate in the market. So if you believe that market makers make money, then if you can faithfully trade the ideas and you've got enough experience to understand them, then it follows that you should be able to do well enough for that to be positive, right? That's the reality of it. It is literally some of the rarest trading knowledge that I mean, it's just not out there. It's not known because people in these positions don't reach back. There's no reason for them to do it. They're too busy making money, don't care about the retail space, full stop. It's a very rare situation how it came about. And it is a one-off. It really is. What are your stop losses? JP, I'm not sure what the question is there. What do you mean? Like, is my stop 1-to-1 or, oh, right, I see what you're saying. Okay. So the question is my stop, let's say 20 pips and my profit target 20 pips? Or is my stop 20 pips and is my profit target 40 pips? Is that what you mean? Let me know if that's what you mean, buddy. Yes. Okay. So the answer to that is there should not be a rigid number. That's the first thing, because let me just give you an example of that. What you need to do is you need to always be erring on the side of stretching R. So what is R? R is your risk, right? But it's also your reward. It's multiples of your reward, right? So what is R and how do you stretch it? Well, R will obviously differ from trade to trade to trade, but your risk, your percentage risk will remain constant. So whatever that might be, let's just say we go to our earlier example of 0.1. How to stretch R, okay? Well, we're attempting to stretch R as far as we possibly can. So 2-to-1 and stuff like that, no. We're trying to go for a lot more than that, but we can never just have fixed numbers because that's not how the market is. It's impossible to have a fixed number. It's not impossible to have a fixed number, but it's folly. It's the wrong thing to do. Hamid, I'll get to this in answering your question fully, JP. Just 1 second. Hamid, I'm actually a prior student of yours. I have not ever done the one-on-one coaching or stuck to your other stuff long enough. Am I a good candidate for the one-on-one coaching? Yeah, of course you are. You've been around a long time and you've had some exposure to me. So I can, I can whip you into shape quickly from that perspective. Right, let me show you this. Can you see? You should be able to see a chart. Legs are good whipping. Wrong webinar. Right. So, okay. So this 2-to-1 thing, 1-to-1 thing. Imagine this is an area of support, right? Or for whatever reason, I want to buy down in here, right? If I stick some arbitrary figure like 1-to-1 or 2-to-1 or something like that on this scenario, and I'm going to be a buyer in this scenario, I could, let's just say let's just say to that point there is 2-to-1, right? So I take 2-to-1, but the trade's here. I'm not in the trade anymore. So I've just because I've picked some arbitrary number out of thin air, because again, it's not out of thin air because the industry's full of these ideas and what's your risk reward ratios and all of that stuff. It's just not real. It's just not actually true. Let's have a little look. I mean, the last question. I'm just in the middle of another project. Could not start. I'm just in the middle of another project and could not start for at least a few weeks here. Are you okay delaying the start with me for a bit? Yeah, we could start in a couple of weeks, mate. Yeah, no problem. Yeah, I'll still be around in a couple of weeks. Touch wood. Right. So see what I'm saying? So if you put some arbitrary figure on an exit, right, of 2-to-1, you're out of the trades and you can't benefit in this number. Let's call this X. There's no way of benefiting. You're out. You're gone. So how do you do it? Well, one of the other problems that traders face is either they do what you've just said, or they don't really have an understanding of what they're trying to do. They're just going to try and get as most out of it as they can, but with absolutely no plan or understanding of how to manage that. So what I mean by that is this. In this, let's just take this structure here. In this structure, in this area here, in here, there are objectively areas where there are sellers. Right, so forget the fact that you're a buyer. If you're a buyer down in here, you have to be aware that above you there are sellers, right? So it's not like, oh, well, yeah, I see price sold off there. I'm just going to ignore that that that's there, or I see that price sold off there, I'm going to ignore that, or I saw that price sold off from there, I'm ignoring that. You can't ignore that. You have to see it for what it is and recognize that those are areas where there is an objective, non-arguable fact that there was a sellers in those locations, right? So take this as an example as well. Price support, right? Becoming future resistance. It doesn't actually sell off there, but you wouldn't know that. You wouldn't know that ahead of time. So what you've got to do is you have to plan your exits by understanding where the pre-existing order flow is resting, where there is the potential for further newly introduced liquidity to slash order flow to be introduced, and plan your exits that way. So let's just take this as an example. You see this area here. You see how price was going up and down, then it fell away. You see that there? What's happened there? Does anyone want to tell me what happened there? What happened in that situation? So we're getting some answers in. Stops. No. What's happened there is prior to the drop, you had an area where there was a buyer and a seller. But the buyer is gone. Now, obviously, it's not that binary. We don't just have a buyer and a seller, right? But it's helpful to think of it in those terms because it's just easier. So just think of it in those terms. The buyer who was here is not there anymore. So the market sells off. Why does it sell off? Because there's no buyers there anymore. And what the market is it's an advertising mechanism. So just like if you owned a shop that sold chocolate bars, and you had a price for a candy bar, chocolate bar of, let's say, I don't know, £2 for a chocolate bar. I think that's probably reasonable. But no one was coming in your shop because the market didn't think that was reasonable. So what are you going to do? Are you going to leave your prices at £2, or are you going to try and drop your price to attract the buyer? So you're obviously going to do the latter, right? So the price leaves there, and it's proof positive there's a seller there. 100%, not up for debate, not up you can't argue it. There's a seller there. We sold off from there /selling, right? Now, we know that for a fact. Now, what we don't know is we don't know whether or not that seller, when price comes back, should price come back to that point, whether or not that seller will have orders residing there, resting there already. So pre-existing order flow, that's referred to as. We don't know whether that's true or not, but it's probable. We don't know whether or not that particular individual would actually sell more of the said X, whatever this was, right, oil or whatever it might be. We don't know whether or not they're going to sell more of it this time. It's possible. That is actually slightly more unlikely, but it's possible. The final scenario is that it's probable, again, we can't know for certain, but it's probable that other people who have seen that sell-off before might look at that and say, do you know what, I'm going to sell there. So that's going to introduce sell-side liquidity, but it's newly introduced liquidity. So net, what you end up having is in an area where you are probably going to have some selling. You are probably going to have some selling. If you also take into the fact that the buyers down in here would be looking for areas to exit above them to take profit. If you're a buyer down there, what must you do to exit over here? You have to sell, right? So there's going to be sell-side liquidity introduced from that perspective as well. So net, the probability, it's not guaranteed. Of course, we could get to that point and we could blow straight through it. But that's not the question. The question is, how do you stretch? You assume there's a seller there. So you assume that in all these prior scenarios, right? Support, support, resistance at the 76% fib to common fib level. You know what? I think there's going to be a seller there. So when you buy down in here, what you should be doing is analyzing the structures on the way in, on the way down, that you're trading back into, to look to see, number one, how many trades you should take, because it should be dictated by this, by the exits. So let's just say we've identified 4 places where we know there to be some conflicting order flow. Guess how many trades you should take? At least 4. So if we said that we're going to take one off there, and then we're going to take another one off there, and we're going to take another one off there, and we're going to take the final one off there, then what that's done to our R, that we can't possibly know until we're faced with this information. It's always going to be slightly different. It will always adjust, as will how many positions you take, because the structures above or below you will be different. Sometimes there'll be more conflicting flow than other times. But what the exits do is they dictate your entries. And as a consequence of that, that stretches R. So you're not going into it with an arbitrary 1-to-1, because that's silly. You're not going into it with an arbitrary 2-to-1, because that's silly. You're not going into it with an arbitrary 3-to-1, because that's silly. What you're doing is you're accepting that no one controls flow, least of all you and I. And if price comes back into that point, it's very possible that that could turn price. So where you have your one exit, your first exit, it could be the only exit you get, because you don't know who that seller is, nor does anyone, liquidity providers included. The market makers don't know who that seller is. You don't know if you get to that second or third exit, if that second or third exit will turn price, because you don't know who that seller is. You don't know who that seller is. So what you've got to do is you've got to assume, you can't know, but you've got to assume they are there. In which case, yes, the plan is to ultimately, if this whole thing trades out, you'll get 4 exits. Brilliant. But you might just get 1, or you might get 2, or you might get 3, and the third one turns it, or you might get 4, or you might get beyond that. The point is, you allow the pre-existing and the newly introduced liquidity, where there is objectively a buyer or a seller. If you buy in, then it's the sellers you're looking for. And you must plan your exits according to that, because what that does is that stretches the potential for that. It maximizes it. And there is a further strategy that it stretches this even further. But that is if you do that versus the vast majority of people in the retail space, you will be demonstrably better off, because you are stretching R. And R is always, you're always stretching it. You're always erring on the side of stretching it. And every scenario will be different, some by virtue of the fact, because this distance will be bigger in some occasions, smaller on others, right? So it's just going to shift. But however that presents, ultimately you are attempting to achieve more R, knowing that any of these points can turn price. So it takes away the stress of trying to figure out what you're supposed to do. Yeah, you're welcome. Makes sense? Very, very powerful tip. Anybody got any questions? We're just about to wrap it up now, guys. So. And as I say, if anyone's interested in doing some private mentoring with me, send me an email, forexmentoringwithmark@gmail.com, and myself or my assistant will get back to you. And I'm hopefully looking to start with any new mentees next week. So if you're keen on wanting to learn the literal business model of the market maker / liquidity providers, the guys who provide liquidity on a daily basis in any and every market, the actual business model, then give me a shout. All right, chaps, thank you very much for your time, and I hope you enjoyed that. Take care, and I'll speak to you soon. Flavor in stretching your reward for maximum profits, is it your advice also to move your stop? No. So your stop placement, imagine your stop placement is there. Whatever that is R, right? So whatever that represents is R. Obviously, R is different in every situation. Sometimes it'll be bigger, sometimes it'll be slightly smaller, etc., etc. So R will always be dynamic. You can't know it, but whatever that number is, you are then stretching it. Make sense? Obviously, your R is determined, it's based on strategy where you place it in terms of where it makes sense. Hope that makes sense. Any last questions before I go? Oh, okay, guys, I hope you've enjoyed that. And as I say, if you are interested in working with me, send me an email as soon as possible, and we can get that underway. Until next time, take care.